Welcome to the Daily Update Podcast, where I'll go over the action in the market for Friday, November 21st, and we'll see how things look for Monday, November 24th. Friday's close saw the S&P 500 finish up 0.98% at the 6603 level on an Options Expiration Friday. After a higher open and a mid-morning dip below the unchanged level, there was a pretty decent rally on dovish Fed commentary and then late-day selling that trimmed the gains seen earlier in the day. Volume was above average as expected on an options expiration day. Beneath the surface, the tone remained defensive. Small and mid-caps, however, edged out large gains, but value continues to outperform growth. The equal weight version of the S&P 500 did outperform the weighted version of the index. Leadership stayed in staples, utilities, and healthcare, while discretionary and tech lagged, a clear evidence of ongoing risk-off rotation. Some big-picture takeaways include that the long-term trend remains intact, and it's positive. The index is still holding above the 6,600 level, a psychological level. This level also coincides with the volume-weighted anchored moving average, going back to the spring breakout. That level is holding firm as of Friday's close. However, the short and intermediate term trends continue to be negative. Price sits below key moving averages. Breadth and momentum gauges remain weak, and most technical indicators, including the MACD, PMO, McClellan oscillators, bullish percent indexes, Vortex, parabolic SAR, are all negative. The confirmed Hindenburg-Ullman remains active in the background. The VIX closed at 23.4, which is a decline but still above the 20 level. Positive developments that are worth noting include New York Fed President John Williams offering dovish commentary, hinting that a December rate cut still remains on the table. That helped spark the intraday rally. On Thursday, there was extreme put buying, which is often historically associated with short-term lows. A few breadth measures, such as the Swindlen Trading Oscillator, have turned positive. Positive seasonality typically begins during this time of the year and even more after options expiration and strengthens into late November and into December. Areas of caution include growth underperformance versus value across large, mid, and small caps. The smart money indicators still all remain negative, and the TTM squeeze is negative but reaching extreme bearish levels. Economic data that was released on Friday includes the S&P Global Manufacturing PMI, which came in at 51.9. Still above 50, but lower than the 52.5 that was seen last time. The Services PMI did improve to 55 and is showing growth. Consumer sentiment is still coming in very low at 51 and down from a year ago from 71.8. Looking ahead to Monday, November 24th and the week ahead. This upcoming week will be holiday shortened, with the Thanksgiving holiday on Thursday and an early close on Friday. Volume is likely to be light, especially later in the week, which can see exaggerated moves in either direction for prices. The bias remains cautious to negative in the short and intermediate term, while an oversold bounce is possible given Thursday's put extreme and minor breadth improvement. We have yet to see a confirmed shift back to offensive leadership. Key levels to watch include the 6,600 level, which is near Friday's close, as well as the 100-day moving average cluster and the anchored weighted volume moving average at roughly the same level. A decisive break below this zone could easily strengthen the bearish case. In conclusion, Friday's bounce changed very little under the hood. The longer-term uptrend and major support areas remain intact, but the market is clearly defensive on shorter time frames. We can expect choppy price action, potentially lower liquidity, with risk still skewed toward additional downside pressure until leadership and breadth convincingly improve. Thank you very much, and I will talk to you in the next podcast.